Malaysia is an emerging market economy where labor cost accounts for 70% of the total factor cost. That is 1 minus alpha is given to be 0.7 or alpha is given to be 0.3. The long-term trend of labor growth of 5% is expected to continue. Capital investment has been growing at 8%. The country has benefited greatly from borrowing the technology of more developed countries. Total factor productivity is expected to increase by 6% annually. Compute the potential GDP growth rate for Malaysia. So we need the potential GDP growth. It will be the long-term growth rate in technology, that is given to be 6%, plus alpha times the long-term growth in capital. Alpha is 0.3 and the long-term growth in capital is expected to be 8%, plus 1 minus alpha, that is 0.7 times the long-term growth rate of labor, that is given to be 5%. So if labor grows by 5% for the long term, capital by 8%, and GDP grows by, or rather technology grows by 6%, then the total GDP growth in the long run is expected to be 11.9%. Another way to look at GDP growth, or the same formula of growth rate in potential GDP, is the long-term growth rate of labor force plus the long-term growth rate in labor productivity. That is, if GDP has to grow, either the number of people grow, or the same people produce more. That is, either labor productivity grows or the labor grows. If both grows, then even better. The growth rate in potential GDP will be the growth in labor plus the growth in the productivity of the labor. We can think of GDP growth in this equation as well, depending on what data is provided. Labor productivity will generally increase if we have more capital and more technological progress. Study these concepts in more detail. An analyst is forecasting steady state growth rates for two countries A and B, for which he has collected the following estimates. So for company A, the total factor productivity, that will be the main driver of growth in the long run, that is 3%. Labor force growth rate, or the quantity of labor, will grow by 2.5%. Labor cost as a proportion of the total factor cost is given to be 0.7, that is 1 minus alpha is given to be 0.7, and similarly we have the data for B. The sustainable growth rate according to the neoclassical growth theory comes out to be theta upon 1 minus alpha plus the growth in labor. Theta, that is the growth in technology, is 3% divided by 0.7 plus 2.5, that's for company or country A. Similarly for country B, it will be 2 upon 0.6 plus 3.5. So for A it comes out to be 6.79%, and for B 6.83%. So both countries seem to have similar growth paradigms. The growth in B comes slightly more from labor force participation or more labor growth and less from technological growth, while country A has a more or a higher skew towards technological progress and lower towards labor force growth rate. So we can say that the output per capita growth would be higher for country A, that is this first term would be higher for country A and lower for country B. Probably the standard of living will grow better for people of country A.